Good day, viewers. Today we are going to cover financial reporting, September 2016. We are going to cover today question number 32 together. Let's go to the requirement of question number 32 of the paper F7, which is financial reporting, nowadays called FR ACCA. Let's go to number 31. We are here in number 31. Let's go to the required. Required A. Prepare a schedule of adjustments required to the draft profit before interest and tax in the above trial balance to give the profit or loss of Triage for the year ended 31 March 20x6 as a result of the information contained in notes 1 to 4 above. So we are going to adjust the profit that we are given. We are given a profit of 30,000. So we are going to take into consideration note number 1, 2, 3, and 4 to adjust that profit. And we'll be getting 5 marks out of that. Then B, prepare the statement of financial position of TCO as a 31 March 20x6. We are to get 12 marks for that. C, calculate the diluted earnings per share of TCO for the year ended 31 March. There is no need to calculate the EPS. We only require to calculate the diluted earnings per share for 3 marks. So now, all in total, that is 20 marks. So what we are going to do here, we are going to first of all do our workings, then we answer all the questions at the same time. Now here, let's read the scenario. After preparing a draft statement of profit or loss before interest and tax for the year ended 31 March 20x6, before any adjustments which may be required by notes 1 to 4 below, the summarized trial balance of TCO as the 31 March 20x6 is, we are given equity shares, retained earnings, draft profit before interest and tax for the year 30,000, 6% convertible loan note 40,000, leased property, plant and equipment, accumulated amortization and depreciation, leased property and plant and equipment, receivables, other current assets, current liabilities, deferred tax, interest payment, current tax. That's the end of our trial balance. Then now we are given the notes. When we are given the notes, we are now prompted to do our calculations, our workings before we answer the question. We know we are to prepare the adjustment, we are to adjust the profit, then prepare the statement of financial position, then also lastly to prepare the diluted earnings per share. Now, note number 1, TCO issued $400,100 6% convertible loan notes on 1 April 20x6. Our year end is 31 March 20x7. So these loan notes were issued at the beginning of the year. Interest is payable annually in arrears at 31 March each year. The loans can be converted to equity shares on the basis of 20 shares for each $100 loan note at 31 March 20x8. So they are going to be redeemed or converted at 31 March 20x8. So the beginning of the year was 1 April 20x5. So the end of the year is 31 March 20x6. That is the first year. 31 March 20x7, second year. 31 March 20x8, the third year. Or redeemed at par for cash on the same date. An equivalent loan without the conversion rights will have required an interest rate of 8%. So this 8% is a crucial percentage, as we are going to use this 8% to calculate the finance cost to be charged to the income statement or to adjust the profit. And also this 8%, we are going to use it to discount so that this convertible loan note we can easily split the liability portion and the equity portion. So now let's do just that. So before we how to split the equity and the liability portion, we discount all the relevant cash flows of the convertible loan. So we'll say here cash flow, I'll abbreviate as, I will write it in full, cash flow, discount factor is DF, then present values, like that. The first year is ending 20x6. The second and the third we can drag like that. Then the cash flow in the first year is the interest payment. The interest payment is paid at the coupon rate at the nominal value. So we'll simply say 6% multiplied by 40,000. We get 2.4. We can copy that up to year 3 because the interest will be paid in year 1, year 2, year 3. And again in year 3, we are going to also pay the principal of 40. So in year 2, we are going to pay, year 3, we are going to pay 42,300. Now we said we are going to discount using the interest rate of an equivalent loan without the conversion basis. So we are given 8%. Never use the coupon rate or the interest rate of on the loan note. Use the rate without the conversion, which is 8%. I can safely denote it like here, discount rate at 8%. My screen is very small, so I will simply say 8% like that. Then my discount factor is 0.93, the other one 0.86, third year 0.79. Then what I will do, I will say the cash flow multiply by the present value, the discount factor. Same applies year 2, cash flow multiplied by the discount factor. Year 3, cash flow multiplied by the discount factor. If I sum all the present values, I will get the opening balance at 1 April 20x5. I will get my balance at 1 April 20x5 like that. So this is the opening balance. Let me just, for clarity, so that at least it will be seen here. This is the balance at 1 April 20x5, the opening, at the beginning of the year. Now this is the liability. This is the liability component. Let's do undo here to save my screen. This is the liability component. Then to split the liability component, we have to say 40,000 minus the liability component. We get 2,208, which is the equity component. Now, if I have my opening balance as 37, I need to add the finance cost. I said the finance cost will use 8%. So I will say my opening balance multiplied by 8%, like that. I get my finance cost, then I will subtract from that interest payments. The interest payments are paid at the 6% rate. We have already calculated them here. Like this is 2.4. Now we can add everything to get our closing balance. This will be 31 March 20 x6, like this. Remember, we will use the finance cost on our adjustment of profit. We are finished with that note. Let's go to note number 2, which is the non-current assets. We've got a leased property that was revalued on 1 October 20x5. The beginning of the year is 1 April 20x5. So we'll say April, May, June, July, August, September. So that's 6 months. So this leased property was revalued at the middle of the year. So what we are going to do, we are going to say carrying amount April, carrying amount in April. How much was the carrying amount in April? The cost was 75,000 less the accumulated amortization or depreciation of 15,000. So the carrying amount was 60. Then we need to depreciate only for 6 months. We need to depreciate for 6 months. So the depreciation is 25 years at straight line. Let's go to that note. The leased property is depreciated on a straight line basis. So we'll say minus 75,000, which is the cost, divided by 25 years. We get the depreciation for 1 year. Then we multiply it by 6 divided by 12 to get the depreciation for 6 months. That is 1.5. Then we sum up with the opening balance. Now this is the balance 1 October 20x5, like that. Then at this date, the asset was revalued. So we have got a revalued amount. A revalued amount, let's go here, 66.3 million. So it's 66,300, like that. Then we have a revaluation gain. The revaluation gain, we say 66 less the 58, like that. Now that gain is subject to a tax, which is deferred tax at 20%, like that. So we'll say the gain multiplied by 20%, we get our deferred tax of 1,560. This deferred tax does not go to the profit and or loss section, because a revaluation gain goes to other comprehensive income. So this will not affect our profit. Now let's depreciate again for the next 6 months. So before we depreciate for the next 6 months, we have to ask ourselves many questions. At the beginning of the year, we are told here that the leased property has got original life of 25 years. When it was bought for 75,000, it was leased for 75,000, but it has accumulated 15,000. So how many years have passed? So we'll simply say 75,000 divided by 25. we get the depreciation for the year is 3,000. So how many years is 15,000? So we'll say 15,000 divided by 3,000. So 5 years have passed. So at the beginning of the year, this asset had a life of 20 years, and we depreciated for half a year, that is 6 months here. So the asset now was left with what? 19.5 years. So we'll say 66,300 divided by 19.5 years. We get the depreciation for 1 year. Then we multiply by 6 divided by 12. It's a depreciation, so it's a charge. We put it, the brackets like that. Then we sum up to get the balance at 31 March 20x6 like that. Let's carry on with our non-current assets. We are told that plant and equipment is 15% reducing balance. So we'll say carrying amount in April, like above. How much was the cost? The cost is 72,100 less accumulated depreciation 28,100 like that. Then depreciation for the year, of which is this much. Let me put brackets there. Is that much multiplied by 15% like that. Then we can sum up to get the balance at 31 March 20x6. This depreciation again will affect our profit. Now let's go to our deferred tax. Our deferred tax, the opening balance of the deferred tax, we take it from the trial balance. So we say opening balance, which is 3,200. Then the closing balance. Where do we get our closing balance? We have skipped note number 3. Our closing balance, will be taking it from note number 4, which says in addition to the temporal differences relating to information in note number 1 that we have calculated for 1.5, at 31 March, the carrying amount of Triange's cost assets are 12 million more than their tax base. So we'll say 12,000 multiplied by the tax rate of 20, like that. This is our closing. We say 12,000 multiplied by 20%, like that. We get 2.4. Then we say, we sum that. We see here that this is a movement. We see that the deferred tax have gone down from 3.2 to 2.4. So there is a reduction in deferred tax of 800. So we'll say deferred tax movement. Deferred tax has gone down by 800. Then we'll go to our income statement, our trial balance. We have our current tax. If it's a debit, it's an under provision. So we add the under provision. Then we add the current tax, which is the current provision. The current tax is 2.4, 2.7, like that. So when we sum up, this 2.6 is the figure that we are going to use to to adjust our profit. We are going to adjust our profit as well with the depreciation. Let's do the adjustment of our profit. We have got our profit as per the TP, as per the trial balance. How much is our profit as per the trial balance? Is 30,000, like that. The first thing that we need to adjust by is our finance cost that we have calculated above. We have calculated our finance cost here of 8. Please take note that the interest payment was not used as the finance cost, as it is still here showing on the trial balance. So we don't do anything about that. Then we now need to adjust our depreciation. Our depreciation will say 1.5 for the first year, half, plus 1.7 plus the depreciation for the plant and equipment. We get that figure. Then our tax is 2.6. Then we go back to note number 3. Of the fraud of the receivables. Let's go there. In September 20x5, the directors of Triage discovered a fraud in total 700,000, which have been included as receivables in the above trial balance, had been stolen by an employee. 450 of this related to the year ended 31 March 20x5. So the 450 related to the prior year. So how much related to this year? The directors are hopeful that 50% of the losses can be recovered from the company's insurance. This is the hope. We are not going to action that as an asset because they are hopeful, and also the asset is contingent. So now we are going to say the text has to be separated. We are going to say out of 700, 450 relates to the prior year. So what's related to this year? It's only 250. When we sum this, we get our revised profit. That is what was required for 5 marks. Then now let's go to our statement of financial position. Our statement of financial position. Let's we have calculated every figure for PPE. We have got leased property. We add again with plant and equipment. We get our PPE. We have our receivables. Our receivables as per trial balance. $28,000, like that. We have to subtract the fraud of 700. Then we have got other current assets. So for that, other current assets is 9,300. Then we sum everything. Then we go to other section. We have got equity here of 50,000. We have got retained earnings. We'll do a working here. The retained earnings that we are given here is 3,500. less the prior year fraud of 450, we add the current profit that is revised of 14,327, like that. 3,500 less prior year fraud of 450, add 14,327, like that. Then we have got revaluation gain, revaluation surplus. We will take this net of tax. So we'll come here, the revaluation surplus was 7,800 less the deferred tax. We get it 6.2. Other components of equity, that is the share, the equity component of the loan. Let's go there and find it out. It was 2,200, like that. Then under non-current assets, we have got our loan note. Our loan notes, we have calculated the closing balance. Let's go and pick it up. That's 38. Then also we have got deferred tax. Let's go and pick the deferred tax. We have got the deferred tax of closing balance, which is 2.4. We add the deferred tax that we calculated on the revaluation gain. As we said, this deferred tax doesn't affect profit, but it affects the liability in total of the deferred tax, like that. Then we have now our current liabilities, which is the income tax provision. We take it from note number 4, that is 2,700. Then we have got here current liabilities. Which is 17,700, like that. Then when we sum up, hoping everything is correct, our statement of financial position should balance. Yes, it does balance. So it means everything that we have been doing, we're in the right track. Now let's have our diluted earnings per share. That's our last question, our last assignment for 3 marks. We need to adjust the profit first. So we'll say profit. How much is the profit that is adjusted? We'll copy it from here. Then if we are diluting earnings per share, it means we are taking into consideration the conversion option of the loan notes. We are assuming now that the holders of the loan notes will convert, not cash, their loan notes. So how will this affect the earnings per share? It means after they convert, we will no longer be paying interest. At the same time, we'll be paying now the ordinary dividend. So we'll save interest, but net of tax. How much is the interest that is saved? Is the finance cost, not the interest payment. So the finance cost will be saved net of tax. So our finance cost is 3,023, which will be saved net of tax. So we'll simply say here, finance costs, which is 3,023 multiplied by 1 minus tax rate of 20%, like that, because we'll save them net of tax. So the finance cost that will be saved will be added to profit. So now our total profit will be that profit plus the interest saved. We get that value. Then now the shares will now increase. The shares that we have, we'll take them here, which is 50. These are the shares that we have, 50 at the beginning. Now we need to assume that these loan holders also have what converted to shares. So the conversion now, they have got 40,000 worth of loan notes, and the conversion basis is 20 per 100, like that. So we'll get what? 8,000. When we sum that, we get 58,000. Then here, I've already calculated for us our diluted earnings per share, which will be our revised profit divided by our revised number of shares. We get 29 cents. This is what was required of us for 3 marks. All in all, to get our 20 marks that was required in September 20x6. Please do watch this video, comment, and also share the video links with your friends. Watch it time and again, and also please do practice a lot of questions. And also, if you are new and you have not subscribed to my channel, please do so now to support the channel. Thank you.